And it's a great pleasure to welcome Russell back to here. He's been here a lot in the last 2, 3, 4 years, and partly that stems from the fact that he was one of the very earliest people amongst our friends to have worked with Max Watson. You became the deputy director of his financial markets division in 1984 at the IMF, and has collided with Max in many incarnations subsequently, all the way to coming here to be an academic visitor at PEFM during the year 2013-14. And while I say that, I should also say that if you like, looking backwards to 2013-14, looking forwards, we have Charles Enoch sitting here in the audience, who tried to become an academic visitor with us this year, but the IMF wanted him to stay and work there, so determined, so he's going to come in and out on flittering occasions this year, but will come and be an academic visitor with us next year, which we're very much looking forward to. So back to Russell. He was director at the International Monetary Fund, and it takes a long time to understand what the word director means in the hierarchy of the fund, but it's really quite high. His responsibilities were to assess the effectiveness of risk management, control and governance, and the governance process of the IMF itself. He also served as in and led the IMF's Risk Management Committee. He joined the fund even before Max Watson did, way back in 1976, a long time ago, and worked in several area departments. And like everyone else who got on in the fund, he spent time in what's become the Strategy, Policy and Review Department of the IMF. He published on many issues in macroeconomics and financial policies, but what he's done most interestingly to all of us in the last few years is take on seriously the issue of macroprudential policy, the interconnection of macroeconomics and finance. And he was working on that with Max when he was here in 2013-14. Originally, I'm going backwards through this last set of words here, but you started at Columbia as an undergraduate and as a graduate student?
No, my PhD. And UCLA as my undergraduate.
And UCLA, Columbia, and then taught at Columbia for some time before you went to the fund. So very much we wish you welcome back again, and over to you.
Thank you very much, David. My topic, as you see, is about the Troika. I presume everybody knows what the Troika is. It's the three institutions, the IMF, the European Central Bank, and the European Commission, that provide the bailout funds for Euro area members that find themselves without market access. But this is an outline of my presentation. I'm going to start with what I consider the origins of the Troika, which are actually in 2008, 2009, before the euro crisis really erupted. And that happened really in 2010 with Greece, which was then a mad scramble within Europe to find a solution to a problem they didn't imagine to face. And then there was more to come. I will take some time to explain how the Troika works, and did it work particularly well, and what does that mean for the future. Okay, the embryonic Troika. Hungary, Latvia, Romania are the three cases where the IMF lent, along with the European Commission, to members of the EU. And these are the amounts, and you can see the percentages as well. The most interesting part of this table is Latvia, and I'll spend some time in a moment explaining why it's so interesting, because there, the IMF share drops precipitously to basically 23% from an average of close to 65% in the other cases. And there is a significant story as to why there was this change in the financing role of the IMF. Okay. What is interesting is that Hungary was the first use of the European BOP facility in over 15 years. The previous cases were Italy and, interestingly enough, Greece. Obviously, before they were members of the Euro. And the IMF had not lent to an EU member since its famous loans to the UK government in the mid-70s. So a great deal of time had passed, and a lot of institutional memory had been lost, actually, by both institutions. So what happened one day in October of 2008 was the Central Bank of Hungary had, who was the debt manager for the government, had a failed government auction. That is, it could not sell all the government debt it had on offer. Access had dried up. The governor called the IMF and said, I need help, I need money, when can you get here? This was right at the time of the fund's annual meetings, which were taking place in Washington. And the people on the other end...
This is 2008 or 9?
8.
8, thanks.
And they said, 1 minute. There is an article, and I think it's 119, of the Maastricht Treaty, which basically says you have to go to the European authorities first and get permission to borrow from the IMF or to borrow any place where there are conditional funds to be used. So that took place. It also was, since the annual meetings were taking place in Washington, the IMF sort of helped the process along because it directly then spoke with the commission staff involved, saying, we just got this phone call. The IMF mission left that weekend. It took another week before the EU staff could show up because they had to sort out a lot of details about exactly what were they going to do. What was interesting about the Hungarian case is that it was quite clear that the IMF took the lead. This was a flexible exchange rate, there was monetary policy issues, and fiscal issues didn't really pose a problem from a commission point of view because the deficits were within the limits of the Stability and Growth Pact. So it was rather clear sailing from there. Both the EU loan and the IMF loan had conditions, and one other point that was very interesting is the ECB was on the scene as well. It had a repo operation with the central bank, a repo operation that was never actually utilized, but it certainly gave a reason for ECB staff to be there. So what you had was, in this case, all three institutions on the ground at the same time. And that's why I consider this really the origin of the Troika. Then, moving on to 2000, later in 2008, this is December, Latvia gets in trouble and makes the same phone call, but this time it calls the commission first because it's learned the Hungarian lesson. It is also different because it's a member of ERM2. And as a member of ERM2, it has to consult with the ECB. So the same three institutions appear on the scene. From an IMF perspective, what was interesting is that the IMF had been engaged in a debate with the authorities in Latvia concerning their exchange rate. The IMF point of view was that the exchange rate was overvalued and needed to be adjusted, and adjusted by a significant amount. In the terminology of the IMF, it was fundamentally misaligned. But there was no agreement, and Latvia had considerable support from the Commission. So the Article 4 consultation in 2007 was never presented to the board. The 2008, which was sent to the board, was never discussed by the board. So the fund never, as a collective body, never had a discussion about this overvaluation. And boom, they came to ask for money. The fund staff basically said, we cannot provide the kind of money that Latvia needs without an exchange rate adjustment, because it's an unsustainable peg. The Europeans said, we think the peg can be managed and sustained, and we will support Latvia with money to allow it to maintain the peg, which was the wish of the Latvian authorities. And that's why you have this very different financing pattern in the case of Latvia. The other thing that is interesting and important from the perspective of what is to follow is Latvia then had a very significant decline in GDP. And this decline in GDP, which was on the order of 25%, so 1/4, caused the fiscal deficit to expand substantially beyond what had been projected, way beyond the limits of the Stability and Growth Pact. And the IMF and the Commission could not agree on the fiscal adjustment. The Commission wanted far more than the IMF was comfortable with. The IMF felt that fiscal adjustment of that magnitude would only worsen the downturn in GDP, and the pattern of that adjustment effort was going to unfairly impact vulnerable groups. And so the IMF said, no, we are not going to complete our review. Well, the Europeans went ahead and lent to Latvia without the IMF. And this caused all sorts of political issues. The IMF sent a team back and then concluded its review. The outcome of all this, you may or may not be familiar with, is that Latvia had a V-shaped recovery. GDP rose the following year in 2009, and the peg was sustained. And so by 2010, when Greece comes along, it's quite clear that large fiscal adjustment will not necessarily impede growth with a fixed exchange rate system. Or at least that's the lesson drawn by the Commission.
Thought it was clear.
So, Romania, another case of a floating exchange rate. It's back to business as usual from an IMF perspective. You have monetary policy, and it is in the lead. Poland comes to the IMF for a precautionary program. The Europeans at this point don't have a precautionary facility, so they're not involved at all. So through 2008, 2009, you have several examples of different constellations of IMF and EU lending. The IMF reviews all of this in 2009 and basically says the collaboration has worked rather smoothly. The only point of difficulty was not so much with collaboration, but the difference in Latvia about the design of the program. But the Latvian authorities made the choice to stick to the currency peg and to take on draconian austerity measures, which is the choice of the country authorities to make. And the fund had it, then therefore made its choice to reduce its lending. So this is the background to the euro crisis. Now, in 2009, I'm going to skip a little. The first part, I think most people are probably quite clear. The European architecture has no balance of payments facility or mechanism to provide financing to a euro area member. There's a no bailout provision and no monetary financing from the central bank, no firewalls. The IMF had developed its practice in terms of surveillance to deal with the euro area system. That is, there are some policies that take place at the national level, like fiscal policies, and some at the union level, like monetary policy. And so you had to have a surveillance practice that dealt with both of those. But the IMF never considered what it was going to do if it had to lend to a euro area country, because it was considered too unlikely an event to bother with. And I think the Europeans also didn't want that notion to receive any serious discussion. So in October 2009, when the new new prime minister is elected in Greece, he calls the managing director, who at the time was Dominique Strauss-Kahn, who they were both socialist buddies and was looking for advice. Well, the managing director told him the same story. Talk to your European colleagues, because they have to provide you the okay. And by the way, they don't have any facilities to help you out. So I think he felt comfortable that Greece would be back. Well, France and Germany proceeded to have a debate about the fund's role. Essentially, the Germans wanted the IMF in because, to put it frankly, they didn't think the Commission had the experience and was too politicized to be able to impose the necessary conditionality. The French felt, and this was often expressed by their finance minister, Madame Lagarde, some irony there, that the IMF should not be invited in because it would be an admission of failure by the European project. And that would be damaging to credibility. It would be too difficult for Europe to swallow. And for some, there's a thought it would be too difficult for Sarkozy to be giving DSK a bigger role in Europe, since he might in the future run for the presidency of France. So there are a lot of layers that were going on at the time. So the Commission developed a program with Greece. That program did not have any official financing. The markets didn't believe in it. So you have a situation where Greece does not have any financing, and it has big repayments coming due in May of 2010. There is a deadline. So what happens? In March 25th, you have the heads of states and governments say, we're going to invite the IMF to join us in a package. The IMF says nothing. And one reason why the IMF says nothing is it can only lend to a member. Greece has to ask the IMF for a program. The euro area cannot. That happens much later in April, and the first meeting of the Troika takes place on April 12th in Brussels, interestingly enough, not in Athens. And in a very short time, a program is approved, May 9th, 2010, by the IMF. And at the same time, it expressed doubts about Greece's debt sustainability. What is interesting about that particular event is the Europeans were not at all consulted in that process. As far as the Europeans were concerned, Greece's debt was sustainable. It was only an internal debate within the fund staff that caused the change in the fund's own rules. That is, to add what's called the systemic exemption clause. That is, spillover effects from a Greek restructuring would undo the euro area. And this was done because staff, or at least a sizable portion of staff, did not believe that the debt was sustainable with a high probability. To be clear, fund staff were divided on this issue. So it was more a question of probability than certainty. That has changed, but we'll see later. These are the flows that the fund and Europe has provided. In the initial stages, you'll see it's essentially roughly 2 to 1, twice as much from Europe as the IMF. But then with the second Greek program, the EFF, and Cyprus, the fund share drops. And it drops because of issues having to do what's known as private sector involvement. The large share from Europe in the EFF was to finance the debt reduction operation with the private sector. What it meant is that a lot of official money went in to pay for that private sector involvement as sweeteners to get the voluntary debt deal. If you read papers by Zettelmeyer and others, he makes, I think, a persuasive case that that debt restructuring was too expensive and with too much official money going in.
Can you explain exactly what you mean by sweeteners? Who paid who what for what reason, or with what effect?
You did essentially a debt swap of instruments.
Oh.
And to encourage you to voluntarily turn in your old debt.
All right.
Because remember, this is all done voluntarily. Then you would get not only a new Greek instrument, which had a longer repayment term, but what you would get is official money would guarantee a portion of that new debt.
Right.
Or in some cases there would be a buyback, and the buyback would be the official money, because Greece had no money, so it would come from the European.
And the buybacks were below par. By how much, roughly, below par?
I think 25% on average.
That's what I thought.
Russell, can I just?
Sure.
So, the Europeans are bailing out their own banks rather than Greece, is that right?
And well, they are partially their banks, but anybody who's a bondholder. It doesn't have to be their own banks. Some of the banks that were bailed out were actually banks in Greece, and actually also in Cyprus, which was in part a casualty of the Greek debt restructuring.
But it wasn't bailing out Greece.
That part of the operation did not directly bail out Greece. I mean, the part that finances Greece's current account deficit and fiscal deficit, you could think of as directly bailing out Greece. This other operation is an effort to improve debt sustainability.
Can you explain that second part of that sentence, the part that finances Greece's current account deficit? As a matter of fact, what money went to who to do that? Was that the purchase of Greek government debt by the official institutions?
Well, think of it as there's a flow and a stop.
Yeah.
The current account is a flow, and it basically measures how much you're living beyond your means.
Yeah.
And you need foreigners to provide you money to buy imports that you couldn't otherwise pay for. So the IMF and the European bailouts finance those imports.
By buying which actual instruments? when they do that financing?
A combination of new government debt
Right.
and or bank credit,
Okay, thanks.
which goes to the private sector. The debt operation is a stock operation. It's the existing stock of debt.
Yeah.
So that's
And there's a
different.
mixture of these going on at the same time.
Yeah. Okay. Europe, to do all this, had to build firewalls. The IMF very much wanted this to happen. The first Greek loan facility was 80 billion, and that was essentially bilateral loans from individual governments collected at the Commission and passed on to the Greek government. At the same time, the European Financial Stabilization Mechanism was set up in the EU. So that's an EU entity. Then the European Financial Stability Fund was set up. And this is actually, at this stage, a private sector entity with a legally created in Luxembourg and funded through guarantees by the governments. The IMF was going to contribute 250 billion to that firewall. That's what the announcement by the Europeans said. So with a firewall of 500 billion from Europe, the fund was contributing 250 billion, so you have this famous 2-to-1 ratio, or 1-to-2 from an IMF perspective. There are only two problems with this. One, the IMF board hadn't authorized it. And the other problem is the IMF didn't have 250 billion euros. But nevertheless, it looked good in the announcement. All of this came under Article 122 of the Treaty on the Functioning of the European Union, where it says if a member state is in difficulty caused by natural disaster or exceptional circumstances beyond its control, you're allowed to help out. This applies not to Greece. This applies to Ireland, Spain, Portugal, sort of being the innocent bystander. The 80 billion was for Greece. So there was a split in the logic. Then in March 2011, a new paragraph is added because they realized this was a bit difficult. And that says that a mechanism could be activated if indispensable to safeguard the stability of the euro area. So that is added to the treaty. All of this goes through legal challenges, both in Germany and with the European Court of Justice, the Pringle decision. And it's all considered consistent with the German Basic Law and with the treaty by the European Court. What happens here, though, that is important in the German case is it says the German parliament has to okay every disbursement of money. It cannot abrogate its power over the budget. Other countries follow suit. So there are about 7 countries that are involved who have to consult with their parliaments to disperse money or have a bailout. This becomes important, and I'll tell you why in a moment. The other important thing to remember is that it takes a unanimous decision of all members of the ESM to disperse money or to approve a bailout. So that's really quite a high bar. How did the Troika work? Well, here's the issue. The IMF has conditions. The Commission has conditions. They have to be aligned. They cannot be inconsistent. They can't be inconsistent with each other because if they are, you have a situation where the fund may not be able to lend when the Commission is lending, or vice versa. But there's a more fundamental reason they have to be consistent, and that is the country can only implement one set of policies. So they have to be able to implement what you're saying, and if they implement it, it should work for both sets. Now, according to the IMF rules, IMF cannot borrow conditionality from another agency. That is, we can't rely on what you say to disperse IMF money. That fiduciary responsibility has to be with the executive board based upon the program negotiated and approved by the fund executive board.
What does that mean in practice? That for a particular example, the IMF couldn't lend money to Greece because the Greeks had promised something to Brussels. Is that what that sentences mean?
No. Because you can promise something to Brussels that is outside the IMF program.
Sure.
And supportive of the program. And that's fine.
I think I'm mixing up necessary and sufficient conditions. It would not be enough to get money from Washington only to promise stuff to Brussels.
Correct.
You need also to promise to
something
Washington.
to Washington.
Thank you.
Right.
Yeah.
And the two have to be consistent with with each other. Now, the fund's policy says that in its designing a program and the conditionality, it will be consistent and integrated with those of other international institutions within a country-led framework. This pre-existed the euro area and was intended to deal with something like lending between the World Bank and the IMF. But as you can see, it also applies to this situation. So you have a program, in theory, that is the Greek government. It presents it to the Commission, it presents it to the IMF. It's coherent, it's acceptable, and it's integrated effectively between the two institutions. To make all this possible, what you have going on underneath is that the IMF and the Commission staff are basically sharing drafts at all stages of the process. Before they go on mission, when they're on mission, and when they come back from these trips. This ensures consistency about conditionality, and also ensures that they speak with one voice, in most cases, with the authorities.
Don't quit that last one.
Yeah. One aspect of bank fund collaboration doesn't work, and that is the lead institution. And that's because when the bank and the fund deal with issues, the IMF deals with macro issues, the World Bank deals with structural issues and more micro issues. The Commission deals with virtually everything. It deals with fiscal policy, the Stability and Growth Pact, and it deals with financial sector, it deals with structural policy, labor markets, everything. So what you have is the fund and the Commission who are essentially overlapping in their responsibilities, which creates a much more difficult situation for both of them. There's also a difference in the governance structure between the fund and the Commission. The Commission is doing this on behalf of the Eurogroup. This is not a power that the Commission has. It's been delegated to it. And the Eurogroup keeps Commission staff on a short leash. The IMF structure is very different. Fund staff have their marching orders from Washington, but once you're in the field, you have a great deal of responsibility. And the executive board, which you can think of as being equivalent to the Eurogroup, is totally out of the negotiating process. And so this is done at a technical level. There are political inputs from, at times, from the managing director and on certain issues, but it's a much more technical process from an IMF point of view than it is from the perspective of the European Commission. And so there's an information asymmetry that grows up as a result. European finance ministers in the Eurogroup know almost on a daily basis what's going on. The executive board at the IMF only gets periodic and substantially less detailed information. For example, the fund board would be told, this is going to be a program that requires exceptional access, a large amount of money, but until it was actually negotiated, they weren't told the exact numbers that fund staff were thinking about, and which were actually told to fund management. Because the fund needs to have a program that fits together, fully financed, you had the Eurogroup had to say, okay, we're going to provide this amount of money before the IMF could move. This gave the Eurogroup considerable importance, and it means that the Eurogroup had to consider the program before the IMF board could consider it. There's also a different in perspective. The IMF goes to a country like Greece or Cyprus. It takes the perspective, what is good for this country? What kind of policies suit this country? It's not necessarily trying to deal with what are the spillovers to other European countries. When you take the perspective of the Eurogroup, they're very much interested in what's the precedent this is going to set for the rest of Europe. Are we comfortable with this precedent? And the Commission finds itself in both places because, one, it has a job of enforcing the EU treaties and doing what is good for the EU as a whole, where at the same time it is negotiating on behalf of the Eurogroup. And that may produce some strains in addition. Fiscal performance, there are problems there between the fund and Europe in terms of how they design it and how they look at it. Structural conditionality, the fund believes in parsimony, that is only things that are macro-critical, so it has very few structural conditions. The European structural conditionality goes on for pages and it basically covers hundreds of items.
And that's new for the fund. It postdates clothes in Indonesia, doesn't it?
That change, yes. And the clothes in Indonesia, the experience more broadly of the Asian crisis caused the fund to scale back structural conditionality and change the nature of it. But that's not the European experience. And this is an example where, the fund structural conditionality is quite limited. The European is quite extensive. This could cause problems because many of these countries don't, and I won't name names, but they don't implement the structural conditionality completely for Europe. Europe has what they call, in technical terms, review-based conditionality. That is, you don't ask, okay, you did this, you didn't do that. You did this, well, you didn't do this part of it. But what they do is say, look at it in its totality and say, okay, we're willing to complete the review. And by the way, the following stuff you can do next time.
Yeah.
Okay, so it's very flexible is the message I want to convey. So even though it turns out to be very extensive and detailed, it does not stand in the way of the money flowing unless there are other reasons that the money should not flow. Now, from a country perspective, they complain that these missions, there are a lot of people, which is a burden. They have to produce two sets of documents, one for the Commission, one for the IMF. That personalities matter. The teams sometimes get along with each other and with the authorities to varying degree. That when teams turn over staff, it takes a while for everyone to develop trust. And trust is very important when you're working under a great deal of pressure, under tight deadlines and where you have to convey difficult messages to one another when there are sharp disagreements. Okay, where should this ECB sit in these negotiations? In IMF surveillance of the euro area, the ECB sits across from fund staff with the same side as the national authorities. So this is a very different setup than what the Eurogroup established for lending operations, where the ECB is working in liaison with the Commission. That it has a role of assessing what is being done. It's not a lender, and it doesn't set conditionality, or at least I should say not formally a lender, and doesn't formally set conditionality. That's formally done by the Commission in terms of the Memorandum of Understanding. But the ECB does have its views and is certainly willing to express them. And in many of these cases, it is a large creditor. It's a large creditor because it has lent to support the banking system, or in some other cases, it has lent indirectly to the government because of something known as the Securities Markets Program. It's bought the debt on the secondary market, which became a big issue in debt restructuring. What is interesting in the case of the letter of intent and the memorandum of understanding, the letter of intent is the document for the IMF, is the governor of the National Central Bank sits on the same side as the country authorities, that is across from the ECB. And the governor signs the letter of intent along with the Minister of Finance of the country. And why is this? It's not because of monetary policy, clearly, because they don't have a monetary policy. It is the case that the National Central Bank is responsible for bank supervision. This is pre the single supervisor setup, which just went into effect in November of last year. So they're there as the supervisory authority of the financial system. And this is different than the funds experience in other currency unions, where it's only the Ministry of Finance that signs the letter of intent, because the regional central bank is the supervisor. And there is no national supervision in those cases. One thing to think about is the security markets program in the OMT, it escapes my memory right now, but outright monetary transactions, and the single supervisory could bring some change to this. Why? Well, let me start with, I'll omit OMT because it's not been used. But the security market program, what does it do? The ECB buys the debt of individual countries. By doing that, it changes interest rates for that country. That's really not any different than any central bank going into the market and setting interest rates. So you could think about it as the ECB is essentially conducting monetary policy in Greece, and it can set it separately in Ireland and separately in the euro area as a whole, because you have now a fragmented financial system. You don't have a single market in Europe. The single supervisor, well, we just had the discussion. The ECB now is a supervisory authority for all the banks in the euro area, including the banks in Greece. So if you need to do something to recapitalize the banks in Greece, if you have a problem with supervision in Greece, well, then you have a problem that you have to discuss with not the National Bank of Greece, but the ECB. Whether that's easier when they're sitting next to you at the table or across from you, we will come to. Here's the question that many people ask: is the fund a junior partner? Well, clearly in a financial sense, it is. Is it in terms of how the program is designed? If you read the press, you get the impression, yes. If you talk to Troika participants, be it at the IMF, the Commission, or the ECB, they will say no. And I will add, if you go to the European Stability Mechanism, they will also say no. And by the way, more recently, because of the European Stability Mechanism's involvement, the Troika is considered an outdated term. And it's not the institutions, which sometimes the Greeks like to call it, but it's the quadriga, which instead of being a three-horse chariot is a four-horse chariot. And I sometimes say, and it's not the four horses of the apocalypse.
That's a good Freudian slip.
Well, it was somewhat planned.
But what's the fourth horse?
War.
No. This.
The fourth horse is the ESM, the European Stability Mechanism.
Of course, thank you.
Which finances it and which does the debt restructuring. Now, the IMF is not a senior partner either in this. It's a structure where each institution basically has a veto. And how does that work? Well, the Europeans have a veto, one, because they have most of the money, and two, because the country authorities are a member of the European Union, and more importantly, the Euro area, and they want to stay that way. They want to be a good Euro citizens, so they will go a great deal in trying to accommodate the wishes of those authorities. What leverage does the IMF have? Well, every time Merkel goes to the Bundestag and says, I want a disbursement, they ask, what is the IMF up to? Is it dispersing? What are the IMF's view? This same question happens in several other parliaments throughout Europe. They want to know, is the IMF going along with it? And if not, why not? So if the IMF is not participating, and there may be serious reasons for that, then that's enough of a threat to cause the power makers at the political level within Europe to say, we need to think about whether or not we want to pursue this course. So effectively, each side has a veto power. Now, what about examples to sort of test this hypothesis? Well, the opening gambit on Greek debt sustainability, the Europeans said it was sustainable. The IMF didn't have a view. It was debating it amongst itself. And within the fund, I think the basic view was, we have our doubts, this program may work, but if we restructure Greece now, it could unravel the euro. And there could be contagions to other countries because the firewalls aren't there to protect these other countries. So there was a real concern, at least in 2010, that a Greek restructuring would undo the euro area, which would have a blowback effect on the US. So the US was also not interested in seeing a Greek debt restructuring in 2010. In 2012, the Eurogroup charged the Institute for International Finance with negotiating a voluntary debt restructuring with Greece. They reached a preliminary agreement. There was discussions before the Eurogroup about this deal, and the IMF did a debt sustainability analysis, and that analysis basically said, no,
Not
the
enough.
debt's not sustainable with that deal. And that deal, therefore, got scotched. And a new deal replaced it in due course, but a great deal of time was lost as a result. So that's a clear case where the IMF was not a junior partner. It took on the authorities in Europe and convinced them of the logic of their case. This is not a political weight, but it's an economic argument. In Ireland, the IMF wanted the senior unsecured bondholders to basically have a haircut. This was the view, and I think Jay Chopra came here last year,
Yeah.
and he was the mission chief for the IMF to Ireland and made the case why this made sense. The Europeans, particularly at the time, the president of the ECB, did not want that to happen for worries about contagion to the rest of Europe. This issue was taken to the G7 by the IMF, by Dominique Strauss-Kahn in particular, and there was a discussion, and the G7, particularly the US, said it's too risky. We do not support burning the bondholders. So it didn't happen. Now,
Sorry, so what happened? There was no haircut.
there was no haircut for the senior unsecured bondholders. The point I'm trying to illustrate with this example is this doesn't have to do senior-junior. There was an economic case of risk to be adjudicated. There was a difference of view between the fund and Europe. It was taken to the G7 for adjudication. Think of it as being an appeals court. They made their judgment that it was too risky.
What was the position of Ireland in
Ooh,
Ex post, Honohan has said that he was very careful when he came to speak to us here. He said that it turned out to be a very small proportion of the burden that has been imposed on the Irish citizenry, and so small that to get het up about this egregious impropriety of not burning the bondholders was to worry about the wrong thing, and you ought to just get on with your life, was roughly what he said, which didn't quite answer the question,
yeah.
but evaded it in a kind of constructive way.
If
I think that's a fair description.
I think it's a
Anyone
fair
else here,
description.
when he spoke, I think that's more or less.
If the Europeans would have allowed it, the Irish would have probably done it,
Yeah, that's right.
to put it a different way.
Yeah.
Now, the Europeans would also say, we renegotiated the terms on your debt that you owed us and made you whole in the process.
That's right.
So there is a,
And got the
if you play the game properly, you'll get rewarded as well through other means.
the bonds weren't written down, but in the end, the risk spread was compressed by a series of rather complicated actions that
Right.
paid off the Irish for not burning the bondholders,
Right.
roughly speaking.
Now, this was done at the same time that they were giving the Greeks a better deal on their interest rate. So whether or not the Irish might have benefited in any case, it's hard to know. It's a complicated story. But There are also the pace of fiscal consolidation and the pace of deleveraging, in particular by the ECB, goes through all these cases. There, it's much more a muddle as to influence. Sometimes IMF succeeds in slowing the pace, and sometimes what you have is a compromise where no one is particularly happy. And there's, as you can see from a lot of the discussions which have been presented, at least within the IMF, there is one side led by the research department and Olivier Blanchard, who certainly feels that the pace of fiscal consolidation in these countries was, on the whole, too much. And he would also say the pace of deleveraging, that is, reducing the size of the banking system, made monetary conditions and lending conditions too tight, too fast, and only made matters worse. Now, this is not the first time that the IMF has lent in a crisis situation with other governments. This has happened in the Asian crisis, in Latin America, the tequila crisis with Mexico. But what is different is, in my view, not so much the Troika arrangement, that is, the coordination between the Commission and the IMF, but it's the currency union membership, the rules of the currency union that exist, and the fact that often these country authorities want to abide, want to be good citizens of the currency union, and indeed, in many polls, their populations say quite clearly, we want to stay in the union, and if it takes this to do that, to stay in the union, austerity prevails. So it is really, in my perspective, it's this membership in the currency union that is driving a lot of the difference between the fund's influence in Europe compared to the influence it had in Asia, in Latin America. Okay, what's to come? First of all, I'll tell you right now, I don't know. And this is meant to try to elicit some reactions from people. The first question is, of course, Greece 3.0. We already have the 3.0 with the European Stability Mechanism, a new program. The IMF is not part of this program as yet. It is supposed to join at the time of the first review. The time of the first review was expected in October. When's that? As you probably have read in the press, the main issue right now between the fund and the Europeans is a question of debt sustainability and how is that to be achieved. The IMF says there are a number of ways it can be done. Europeans are talking about extending maturities, lengthening grace periods, but that has to be done by basically doubling the maturities and doubling the grace period. So we're talking about 50-year or 60-year maturities and no repayments for 30 years. But they have also said, the Europeans, that no haircut is possible. The logic for that is not totally clear to me. But it's the link they make is to the no bailout and no monetary financing. So to provide a haircut would be to directly go against the treaty. Often people say, well, if you don't like one lawyer's answer, you need another lawyer. So I'm not sure how this is going to work out. The ESM treaty says that the fund has to be involved wherever possible. And so what that means is going to get a new test, possibly in a short while. It did already have one test in Spain in 2012, where the fund did not lend, but the ESM did, and the fund only gave advice, that it gave technical assistance. How is this possible? Well, it wasn't because the provision, wherever possible, came into play. The fund did not have a specific lending facility for bank restructuring and recapitalization. And so, because the fund didn't have such a facility, the ESM could go ahead and go without the fund. That's the logic. Now, it is also the case that the program the fund has had with Greece, Ireland, Portugal, Cyprus, all included money for bank recapitalization from the IMF. So even though it doesn't have a separate facility, it doesn't mean the fund cannot lend for that purpose. Probably the key determinant in all of this is that the Spanish didn't want an IMF program, and the Europeans didn't want it. Why? Because at that time there was a great deal of concern about contagion, a desire to differentiate Spain from the other countries, to draw a line in the sand, because if Spain needed an IMF program, what other countries might also follow suit? And here Italy was one that at the time people were concerned about. So, what about transforming the ESM into the European Monetary Fund? What does that mean? That would mean that it would negotiate the conditionality and do the lending. You would take the Commission out of it. Therefore, it would not have this conflict between its role of defending the EU treaty and working on behalf of the Eurogroup. The ESM, which is only composed at the board level by the Euro area, would have a direct link. And therefore, the Commission would only do surveillance. It would handle this through what is known as the macro imbalances procedures. It would handle the Stability and Growth Pact. Only when you didn't need money would the Commission be involved. This sometimes, by the way, has been proposed to separate the IMF between its surveillance and lending practices. This used to be a favorite recommendation of the UK government some years past. The ECB is, the European Parliament has endorsed the idea that the ECB should be an observer and an assessor going forward. And that's all its role should be. But my perspective is that cannot work. Cannot work because it's the single supervisor of all the banks, and therefore you have to talk with the ECB about the banking system and the quality of the banks and the quality of supervision. Secondly, it has macroprudential instruments, including such things as the security markets program, which can make interest rates in an individual national economy different than elsewhere within Europe. And because it can make monetary conditions in a Greece or Spain or elsewhere that are different than the euro area as a whole, you need the ECB at the table to say, okay, what is it you're going to be doing in this country? What level of interest rates are you going to be setting for this country, for this national economy? That's no different than a discussion that might take place with the Mexican Central Bank about interest rates in Mexico. At least that would be my perspective. Okay, finally, you have this macro imbalances procedure, which looks at what's potentially surplus countries like Germany, Netherlands should be doing, as well as deficit countries. This is the age-old question of how you balance the adjustment process. You shouldn't just ask the deficit countries to adjust. The surplus countries need to do their bit as well. But there's really no mechanism to make that happen within the euro area at the moment. In my view, you need to change the criteria and thresholds and design of the macro imbalance approach to give it more analytical acceptability. And then you also then need to give it more teeth so that it can work on the surplus countries in support of the deficit countries. What about the role for the fund? If you have a European Monetary Fund, is there anything the fund can do or should do? Well, first of all, it's not about the money. It never was about the money. Presumably, the Germans and everyone else will be comfortable with the European Monetary Fund. They'll trust it to impose the kind of conditionality that they think is acceptable and acceptable more broadly to the Eurogroup. But there's another interest. The rest of the world does care about what goes on in the Eurogroup. It's important for the rest of the world. And those global spillovers mean that the fund perhaps should have a dialogue in some way with the European Monetary Fund, with the Eurogroup, about the implications of too much adjustment in the euro area, too little growth, too low inflation. And at the same time, be what I term here as a trusted advisor. Here's how you need to change your architecture. Here's how you need to tinker with your policies. You may not like to hear it, but someone has to tell you when there are problems in the course that you are setting. And finally, there's a question, what about banking union, transfer union, political union? In the discussion about Greece, one of the ways to solve the sustainability problem that the IMF has put forward is that the Eurogroup or the EU could provide grant financing to the Greek budget for a number of years, if not decades. That's one solution. If you can't haircut the debt, if you can't reduce the interest rate more, and what happens when at some point in the future, say 10 years from now, the ECB raises interest rates, and interest rates rise and the debt service rises beyond what is now projected for Greece, how are they going to pay that? Well, transfer union would solve that. But transfer union, fiscal union, also raises a whole question about political union and governance within Europe, which is a much deeper and more fraught conversation. But it's where ultimately things may have to lie. But whether or not that's a discussion that Britain will be involved in is something no doubt we'll find out before too much longer.
Thank you so much.